Good evening, everybody. Thanks so much for joining us. My name is Scott Jacobs. Some of you may know that. I'm one of the partners and wealth advisors at WRP Wealth. So we're really glad you're joining us tonight for a webinar. Tonight's topic is going to be on long-term care planning. It's the continued education series we have throughout the year, bringing various topics that are coming up from clients and things that are topical as 2026 continues to move forward. Look for more of this. It's a topic that families are facing. If you haven't faced this thus far, it may be something that's coming. It's coming up a lot, and it continues to come up as the population continues to age. So our goal tonight through the evening is really to help you better understand this topic of long-term care, potentially the impact financially to you and your family, and maybe some of the strategies that may be available to you to prepare. So just a quick disclosure, tonight's conversation is for educational purposes only, and Carly Ebenestein will be our featured speaker tonight. I'm really excited to introduce you to her. She's a 30-year veteran in the insurance business. 15 of those years have been focusing specifically on long-term care, and she'll help guide us through this discussion. I've been doing this for about 32 years myself, not on the insurance side, and I've been searching for a third of a century to find someone that leads with education on the insurance side, that doesn't just try and sell stuff to the public. Carly is all of that and more. My biggest fear is when she retires, but for now, she's still at it, and I'm looking forward to this conversation tonight. And with that being said, I'll turn it over to Carly Ebenstein for tonight's conversation. Carly?
Thank you, Scott. I'm Carly Ebenstein. I'm an independent broker. On this slide, it shows that I'm licensed in California and Colorado, but I'm licensed in about 10 other states as well. I've been in the business for 30 years, focusing on long-term care insurance for 15 years, and I love what I do. I want to thank WRP Wealth Managers for helping for presenting this educational series and being so gracious with their time, and all of you for taking time out of your day to learn about this important topic. So we're just going to get this disclaimer out of the way. I am responsible for all this material. So when I touch on financial matters, tax matters, estate planning, then that's, I know enough to be dangerous, but you should really be checking with your experts in the field, and WRP is not responsible for any of this information. So today we're going to talk about the following topics. What is long-term care? What is long-term care insurance? How do people receive long-term care? Different types of long-term care plans and underwriting. We're going to cover the elephant in the room, self-funding. We're going to talk about Medicare, different options, the Pension Protection Act, deductibility of premiums, and then I'm going to give you a couple scenarios before I take questions. Some of you have submitted questions ahead of time, and I have them here to address. And for any other questions that come up along the way, please put them in the chat and we'll get to them, as time permits. The other thing I want to mention is that there is a cost of care calculator link in the chat. I don't want you to get distracted with that now, but that's something we'll talk about towards the end too, and something that you can have for yourselves to just look at the cost of care across the country. So what exactly is long-term care? We hear this term mentioned all the time, but what exactly is it? Well, in my business, we think of long-term care when someone has problems with the activities of daily living. That is a term that almost defines long-term care. And the way I always remember these activities, or ADLs, these are things that happen within the first hour of waking up. You get out of bed or a chair. That is transferring. You walk over to the bathroom. You shower or bathe or sponge bath, wash your face. All of those things encompass bathing. Continence is its own ADL, dressing, putting your clothes on, and then eating, not preparing food, but actually eating. And the reason why I have balance there is because balance affects transferring, walking, most likely bathing, and possibly even dressing. And when somebody has problems with 2 of these 6 ADLs, a long-term care claim will most likely be approved. And it doesn't mean that you can't do them. You have to be able to do them safely and without supervision. So white knuckling it through or falling while you're doing these things, that's not acceptable. And a claim is most likely going to be approved when you have problems with 2 of these 6 activities of daily living. Now, sometimes people don't have problems with the ADLs, but maybe there's cognitive decline to the point where it's not safe for them to be spending too much time by themselves. Maybe they have a tendency to leave the stove on or the car running, or they wander, or they can't handle like simple financial equations, to nobody, I don't know people that balance their checkbook anymore, but they wouldn't be able to do that, or they get you get confused very easily. That in itself is enough to qualify for long-term care benefits. So, what exactly is long-term care insurance? I want you to think of this as a personal tax-free care fund, like a big pool of money. You control the size and, access by designing that with your long-term care expert. And the thing is that once you sign the final documents, if you've approved and you sign the final documents and you've made the first premium payment, then you have access to that pool of tax-free funds. Now, there are different types of plans that are available. You have traditional, hybrid, and short-term care. Traditional is exactly how it sounds. These are the plans we've always heard about, like from the beginning. These are also the plans where when you hear about rate increases, it's about these types of plans, but the premiums tend to be low. The benefit duration tends to be between 2 and 8 years. There's one company that still has lifetime. There's no death benefit. The underwriting is the most rigorous for traditional plans. There's inflation protection. It is possible to purchase a plan without inflation protection, but most likely that doesn't make sense. And when you're designing a plan, there are just many ways to customize your coverage, and you'll have the option of choosing between 1% and 5%, usually compound. Some plans offer the choice between compound and simple inflation. Traditional plans have the ability for tax deductibility. So this is another place where I know enough to be dangerous, and you should check with your tax advisor. But if you itemize your taxes, then you might be able to deduct a part or possibly even all of your long-term care premium with a traditional plan. Businesses also have benefits depending on the entity. Again, check with your tax advisor, but businesses also have the ability to deduct premiums and still receive the benefit tax-free. Partnership is actually a whole topic in itself, which we could have a part 2 of this. But in essence, partnership is something that's available for traditional long-term care and not for the other types of policies. And then the issue age range, that will go between, 30 to 79 for traditional. Now, are many 30-year-olds getting long-term care insurance? No. But it used to be that you couldn't even get it if you were 30. You had to be at least 40 years old. So it's available, and there actually are people that are purchasing it when they're that young. Hybrid plans were created to address the concern of a traditional plan being a waste of money if somebody passed away before needing benefits. So hybrid plans were created, and they're a hybrid with life insurance. So the premium is higher because there's life insurance attached. And basically, the money is going to be paid out one way or the other, either in claims for, a long-term care event, or to the estate, or possibly both, depending on, again, how the plan is designed. The benefit duration, again, 2 to 6 years. I actually do have to update this slide because there is one company that has a lifetime benefit. There is a death benefit that's guaranteed, and also premiums are guaranteed with hybrid plans. The premiums will never go up. So when you hear about rate increases for traditional plans, that does not affect hybrid plans. Underwriting tends to be more moderate. It's not as rigorous with traditional. And partially that's because it's more expensive. More people, less people are applying for hybrid plans. Less people can afford hybrid plans because they're more expensive, but underwriting is more moderate. And also there's inflation protection that can be designed, added to the plan when you design that with your long-term care expert and wealth advisor. There's tax deductibility when plans separate the amount of premium that goes towards life insurance and towards long-term care. That long-term care portion is available for tax deductibility, if you're able to deduct. That's a whole other separate topic. But now, it used to be that very few plans actually did separate the premium, but insurance companies are definitely making lots of changes, according to demand and interest. And so now that's very common for those premium dollars to be separated. There's no partnership available, and the issue range is a little bit broader, from 25 to 80 plus years for a hybrid plan. Now, short-term Care plans are interesting, and I want to say that they're not available in all states. So they're not available in California, New York, or Massachusetts. There might be a couple other states where they're not available, but short term care is exactly what it sounds like. The maximum you can purchase a plan for is 1 year for home care, maximum, and 1 year for facility, maximum. These plans have a, shorter benefit duration for each type of service. There's no death benefit. It's the most lenient underwriting. There can be inflation protection. There's no tax deductibility. It's not partnership eligible, generally speaking. And the age range, it goes much higher, up to even like 89 for certain plans. But this is really the kind of plan that somebody gets when either they can't get anything else or there are a lack of funds, because these plans are definitely cheaper. So which plan is right for you? That's all going to depend on so many things, your goals, your health, your age, the conversations you have with your wealth advisor, and how you decide to design the plan with your long-term care expert. So I get a lot of questions about underwriting. What is that like? Well, there's a process. Once somebody decides on the plan that they want, then your long-term care expert's going to help you complete an application. Sometimes it's extensive and sometimes it's short. It all depends on the company and how they're handling that. But your long-term care expert can really help guide you through this process and coach you through this process, because you really don't want to provide information that's not being asked of you. I always tell people when we're completing an application, now it's time to think like an attorney. Only answer the questions that are asked. Many companies will have a phone interview where they're going to confirm the information that's been provided on the application. Sometimes it's a link for you to answer online, but most of the time it actually is a phone interview. And then, depending on your age, there might be a cognitive assessment. Medical records might be requested, not always, but they might be. And then a decision is made, and that determines your final rates. So I go to great pains to try and get it right by asking lots and lots and lots of questions, but sometimes there's a surprise. Like if there's something unexpected in your medical records, that could definitely affect your rates. And then once your policy is issued and you've signed the final documents and made your first premium payment, you actually have access from day one to that pool of tax-free funds. Now, what are some typical conditions where there's a decline? Dementia, Parkinson's. If you need help with any of the activities of daily living, active cancer treatment, clearly a wheelchair or walker. One thing that I'm not sure if you can see, because it's actually cut off on my screen, is physical therapy. And physical therapy sounds very benign compared to all these other things. And it actually can be benign. I had a client who was the picture of perfect health. But when he told me that he was going to physical therapy for tennis elbow, we actually had to delay his application by a month because we needed to wait until he was completely released from that physical therapist's care. So a good long-term care expert is not going to have their clients go through this whole process just to be declined. They'll tell you upfront whether it's, you really can't apply, whether it's going to be a waste of time, or whether we need to actually delay the application. And then there are medical conditions that affect different rate classes: diabetes, cancer in remission, height and weight, sometimes being treated for a mental health condition. That doesn't mean taking, an antidepressant. It means it's more intensive than that. Someone who's just taking one antidepressant or even two, that may affect the rates, but someone could also get preferred rates. And so these are the different underwriting health classes: preferred, standard, a decline. This is basically the same, slide as before. But one thing to keep in mind is that the age that you apply is what, will help determine. It's a big determining factor of what your rate is, that and your health. Now, if you have a hybrid plan, that's the rate that's going to be for the entirety of, the policy. If you have a traditional plan, that's the rate you're going to have until there's some kind of rate increase. And as you can see, the chances of, getting lower rates go up as we get older. So unfortunately, I would say every month I talk to people who I have to let them know that I really can't help them, that they've waited too late. And so I always like to really stress. I feel like I'm on a mission to let people know that a long-term care event can happen to anyone at any time. This isn't just for someone who's older. Care may be needed due to an accident or sudden diagnosis. A lot of people seem to think that long-term care and long-term care insurance benefits are only paid for facilities like nursing homes and assisted living, but actually most of it is received in the home. And care could also be received temporarily. For example, I had a client who has an RV, and after getting back from a trip, he was washing his RV and he happened to be on top, hosing everything down. He slipped and fell and he broke his pelvis. He was only 52 years old, but he ended up on a long term care claim because he needed care for those activities of daily living for, I think it was a little over 9 months. So he had that plan in place and he had the care that he needed. And then once he healed and didn't need that help anymore, he went off of claim. And that money, that tax free pool of money, continued to grow. So it is possible to be on claim for a short period of time or at a sporadic period of time, and then let that pile grow until you need it later on down the road. And then this is a true fact that 40% of long-term care claims are for people under the age of 65. So if care was needed tomorrow, these are just some questions, rhetorical questions for you to mull over and consider. But do you have a plan? Have you discussed this plan with your family? Do you know who's going to pay the bills? Who provides care? Who's adjusting their life to help? Have you considered how this is going to affect relationships? A lot of sibling fights can start over care for a family member. So, this is a plan of care document. This is a document that is available on my website. It's available for anyone to download. I don't track it. It doesn't mean you have insurance. I just feel so strongly that having a plan and letting your loved ones know about your plan is so important. And so, I hope that you'll consider using this as a template to create your own plan and share it with your loved ones. This is another slide that I provided because this is to kind of help you think about long-term care and completing that plan of care. These are all the different types of care that are available. It's not just, assisted living. There's memory care. There's this adult daycare. And one thing I also want to mention is care coordination and case management. I have some very wealthy clients that really don't need the financial aspect of the long-term care plans. That wasn't the motivating factor for purchasing it. Really, what they're looking for is care coordination and case management to help their loved ones navigate the system, to help decide what care is appropriate, how to find quality care. This is a huge benefit that comes with most long-term care policies sold today. So we've gotten to the elephant in the room. Why is self-funding riskier than purchasing a policy? So the math rarely works out. I mean, I actually have a client who is an investment banker, and I think it was our second or third conversation. He said, "Look, Carly, I can make this money like really easily. So why should I actually consider purchasing a policy?" And I said, "Well, what would happen if you had a long-term care event in 3 years? What would that look like?" And that was really what made him decide to purchase a policy because he could make the money, but he wasn't sure that he would have that period of time to actually make the money. And when you purchase long-term care insurance, you have immediate leverage. When you don't have a plan, basically your entire portfolio, your entire nest egg becomes your care fund. So everything becomes accessible to pay for long-term care insurance. We can never predict the duration or severity. So the average amount of time that somebody's on claim is between 3 and 4 years, but there are outliers. And if it's a cognitive decline, then the average is actually 8 to 10 years. And I can tell you that memory care is a lot more expensive than regular assisted living. Liquidation has consequences. So selling off investments, I have people that say they're just going to sell a house. I mean, you can definitely do that, but then you're looking at a taxable event unless you're paying it out of a Roth IRA. And there also are IRMA surcharges. You can discuss that with your wealth advisor. IRMA surcharges are basically higher amounts that people have to pay when their income exceeds certain limits. For Part B, there are certain limits that people have to stay under to keep that Part B payment at, say, I think it's like about $204 a month for Part B. But if you make more than certain amounts of money, and there are guidelines for that, you're going to trigger IRMA surcharges, and you could actually end up paying, $600 a month for Part B instead of $200. And let's not forget that long-term care benefits are received tax-free. So here are some, I'm not joking, these are actually very modest numbers. I took them from the cost of care calculator, but the truth of the matter is that every time I talk to people and bring up these numbers, if they've had a loved one who has been in assisted living or had extended home care, they're telling me these numbers are much higher. So the numbers for the cost of care are an average. Most people want better than average care, and so that's going to cost more. But over a 3-year period to pay over $400,000 in today's dollars, I mean, that's definitely something to consider. It's a sobering thought and something to discuss with your wealth advisor. Women are usually on claim longer than men. We people are on claim longer for Alzheimer's. And you also have couples where you might have both people being on claim at once. So these are just some factors to consider. I created this for a specific client last year, but I do this for every single client, and it's customized depending on what their situation is. This client, last year she was 55, she's in the Bay Area. She knows that the average cost of care is between $8,000 and $13,000. And she decided that she wanted to do some cost sharing, that she was prepared to pay for care, but she didn't want to pay for all the care. So we started with a $5,000 monthly benefit that could be used for any type of care, facility or home care. We have it growing at 3% compound interest here. The elimination period is 0 days for home care, 90 days for facility. That's something I always design for plans so that people have home care available immediately. I also like to put in a premium waiver so that when people are on claim, they're not paying the premium anymore. Sometimes that's built in, but not always. And the benefit period. I don't want people to get caught up on the benefit period, but I did put it here. The plans end when the money runs out. There's no ticking time clock, but it's to show that if somebody goes on claim and is receiving the full benefit from day one, month after month after month after year with no break, then this plan will end in 36 months. Usually there are breaks for different reasons, but this is realistic. And I wanted to show this client that there was a comparison with a hybrid because she was kind of toying with wanting a lifetime benefit because longevity and dementia run in her family. And you can see that we compared apples to apples as much as possible, but the premium is different. Instead of, a little bit less than $4,700 a year for this plan, the plan would be over $7,000 a year, but it's a hybrid. The premium is fixed forever and it has lifetime coverage, so the benefit will never run out. But this is the type of matrix you can expect if you want me to show you different plans. What about Medicare? Please don't count on Medicare. Medicare is a fantastic program, but it's for medical care. And it really doesn't cover home care. It covers skilled nursing, and you have a lifetime limit of 100 days, but that's for the lifetime. And there are all these different qualifications, like you have to be in the hospital for at least 3 nights. And if you go to skilled nursing, you have to be improving. If you're not improving, Medicare is going to stop paying. So Medicare is a fantastic program, but it should not be thought of as any kind of substitute or supplement for long-term care insurance. I have this slide to really emphasize what I call the epidemic of denial. This is my business, so I see it all the time, and I hear it all the time. I hear all the people say, they're going to just take their chances and all this stuff. But then every month I'm talking to at least one person who unfortunately had to, learn the hard way, and where I have to really deliver some hard news to them. And it's kind of ironic when we look at all the different types of insurances that we have and the likelihood of needing them. I'm not sure if you can see the subtext down here, but this information I got this information from the New England Journal of Medicine. And, the chances of using your auto insurance for, a sizable claim is really 1 in 240. And you can see these other statistics here, but it's really 1 in 3 for men over 65 and 1 in 2 for women over 65. So when you purchase long-term care insurance, you really take control of your options. You have control of every single decision. You could stay in your own home on your own terms. You can choose your facility. To me, this is the most important. Your family can focus on you and not on the hard work of caregiving. Things like bathing, continence, lifting, even dressing. I mean, these are hard things to do. Your assets are better protected. And then there are government tax breaks. And I'm going to get to converting a life insurance policy, which is the Pension Protection Act. So, this is the Pension Protection Act. Some of my clients have life insurance policies that have a cash value. And the life insurance, is less important than it was when they first purchased that policy. But the cash value is something that can be used to purchase long term care insurance. And that can be done tax free. That's part of the Pension Protection Act. And this is a type of exchange that, has really benefited a lot of my clients. It can also be done with certain annuities, and you can also do cash value from a life insurance to an annuity with long term care. So there's a huge benefit for repurposing this money. Business owners have their own benefits. You want to check with your tax advisor, and it depends on the entity, your business entity, but it might make sense for you to have your business pay for your long-term care insurance. Individuals who itemize also, you might have this ability to deduct part or all of the premiums. So when is the best time to apply? In my business, we have a saying that money pays for long-term care insurance, but health buys it. So I always think when you're in good health, that's a good time to at least start looking into it. This is a case study of some clients of mine. We're going to call them Rich and Judy. This is a very typical scenario where one person in the couple doesn't want to be a burden on their children. They've seen what long term care looks like, with their family and how that puts a strain on everyone. They're also concerned about how they would physically support their partner or spouse. And then there tends to be a partner or spouse who's a little bit more reluctant and is afraid that this money might be a waste. And so with this couple, what I did was I showed them, I always show traditional and hybrid because, people need to have their choices. But with the traditional plan, which they did end up purchasing, we included a benefit called share care, where each person could share in that other person's pool of money. So if one person exhausted their pool, with the other person's permission, they could tap into that other person's pool of money. And it's very typical that one person needs more care than the other person. In the end, that's the policy that this couple purchased. And then another client of mine, we'll call him Chris, who's a business owner, doesn't have any dependents, doesn't have any kids. It's funny that people that don't have kids always say, I don't have kids to help me. But people who have kids say they don't want their kids to be a burden on them. But Chris was very aware of, long-term care costs and what that could do for family. And he was very anxious to get a policy. So he was on the younger side. And so what appealed to him was getting a hybrid plan where the premium was fixed. He was able to pay it. Well, he's still paying it off, but he'll pay it off in 10 years. And his business is paying for it and deducting the long-term care portion. Chris also has employees, and it used to be that you had to have at least 50 employees to have a long-term care policy, for your company. But the companies have really listened. And now there actually are plans that will go down to 3 lives, where you can actually get a starter plan for a company where the premiums are really very reasonable. So starting today, if you needed long-term care, what would happen? What would that look like for your situation? Where would that money come from to pay for care? If it's $10,000 plus, month after month or year after year, what is that going to do for your legacy, the family legacy, which what I think of as relationships. So I'm going to go to questions, but before I do that, I just want to leave you with 3 takeaways. 1, I'd really love for you to start creating a plan for yourself and share that with your loved ones. 2, I'd like you to remember that Medicare should not be equated with long-term care insurance or a supplement of any kind. And 3, I think it would be great to start having a conversation with your wealth advisor to really see what makes sense for you. Include them in your plan of care. Talk to them about your plan of care. They have intimate information and they're your partner, in long-term care planning. So I want to thank you, all of you, so much for your time and interest in this important topic. And thank you for WRP for hosting this presentation. And now I'm going to take your questions. So the first question is average long-term care costs by region and state. What tests are needed to determine what level of care is needed? So, yes, care is different between regions, between states, and that's why we have that cost of care calculator. You can actually put in zip codes and look at the cost of care. I do want to emphasize that this is an average cost because when I talk to people who actually are receiving or know someone that's receiving care, it's considerably higher for the type of care that they're wanting to receive. But it's a good rule, but the cost of care calculator is a good rule of thumb. And then what tests are needed to determine what level of care is needed? I'm so glad that you asked that question because it's really not about tests needed to determine care. It's really, I'm going to go back to the activities of daily living. If you are having problems with those activities of daily living, that's going to help guide what kind of care is needed. And your care coordinator is going to help you with that. It's not going to be making decisions. You make your own decisions, but that's what's going to help you. If you think you have enough assets, is it reasonable to wait and see and pay for services needed as they arise? I'm going to say that's a conversation for you to have with your wealth advisor because there's so many answers. So one of my answers to that is even if you have enough to pay for your own care, does that mean it's the best use of your funds? We talked about the tax consequences of liquidating assets and IRMA and stuff like that. And, a lot of people who are wealthy enough to buy their homes, with cash still get mortgages. So I think this is a good conversation for you to have with your wealth advisor. Someone asked, how will we benefit from AI and basic learning tools? Well, we're really in the early stages of AI, so I don't really know how to answer that question, except I will say that I don't think it's out of the question that we could see robots helping with types of care. I cannot imagine at this point that it would ever be a requirement that someone has to use a robot. But if someone wanted to, I can absolutely imagine that that would be approved. And then I guess we all have to use our imagination about how AI is going to play in long-term care. Another question, when is the age to get long-term care and what package makes sense, rate and protection? I think it always makes sense to look into it. I've talked to people who are in their 30s and I've told those people, I've been honest. I'm like, look, if you are planning on having kids and buying a house and, there are other issues that you probably want to be looking at first, I don't think this is a front burner issue, but I really appreciate that they're thinking about it. What's the sweet spot? Most of my clients who purchase long-term care. I've had clients and more and more clients in their 40s are starting to purchase it. And I've also had older folks. Luckily, I've had folks that are in their late 70s qualify for long-term care insurance, which has been amazing that they qualify medically and
Oh,
have the
yeah.
money.
Yeah.
They're outliers, but it can happen. And I'm actually talking to someone right now who's in their 80s and is looking at exchanging money from a life insurance policy into a long-term care hybrid annuity. Someone said, we are in the sandwich generation where we're taking care of elderly parents as well as our kids who are currently in college. I'm interested in learning about our options so we aren't an inconvenience for our kids. Well, I would love to talk with you. I also want to mention how much I truly enjoy collaborating with professionals, WRP Wealth Advisors, where everyone is on the same page and has the client's best interests at heart. How much of one's savings would be good to set aside now for high quality long term care, like living in a higher end memory care facility or nursing home? That's really hard for me to say, and that's a good question for you to have with your wealth advisor. But I will tell you that I talked to somebody a month ago who she's actually an estate planning attorney who told me that her parents had just entered an assisted living facility in Sacramento, which is a less expensive area of San Francisco. And one of the parents is in memory care and that they were paying $20,000 a month for that parent to be in memory care, and then it was, I think, 8,000 a month for the other parent to be in regular assisted living. So that $20,000 number really floored me because I know of Sacramento as being less expensive, and that's what I might expect for San Francisco. It's just hard to say. So if you have an idea, a specific facility, I would maybe contact them and do some research that way. But it's really hard to say. And again, that cost of care is just a starting point. And then somebody wrote in that they have an existing long-term care policy through John Hancock, and they want to know, they're curious about what kinds of in-home services they can expect to get covered, like cleaning services. So I'd be happy to look at that person's plan as a courtesy and go over it with them because all the information is in the policy.
Mhm.
It's really going to come down to those activities of daily living. If you have problems with the activity, whatever activities of daily living, and let's say it's unsafe for you to make a bed, which honestly is dangerous if you don't have your balance. It's not safe for you to clean your home if you don't have your balance. You have to kind of go backwards about the activity of daily living, and that really helps guide the type of care. I'd be surprised if your John Hancock policy did not have benefits for in-home care. It's possible, and that's why I have to look at the policy, but I'm guessing that that would be available to you. So those are all the questions that I have. Do you have other questions, Scott?
We got a couple more came in. Should I look at a traditional long-term care policy or a hybrid policy?
Look at both, because I'm going to tell you, as a long-term care expert, so many times I talk to somebody and I think, wow, hybrid plan makes the most sense for them. Why? I mean, if they're younger, that's kind of a general rule of thumb because the premium is fixed and then you won't be dealing with premium increases. But that's just one characteristic. But I can't tell you how many times I'm surprised by clients where I'm thinking, I think they're probably going to choose this one, and then they choose the other. So I always say, look at both, talk it through.
Yeah, run the scenarios to see which one makes the most
Hmm.
sense. These are sort of interconnected, right? So one question is, what happens if only one of us, meaning spouse and spouse, only one of
Hmm.
us needs care? And then there's sort of like
Hmm.
two-part, which is from a different person, actually. What if we pay for this care and actually don't use the care? Do we lose the money?
Yes, yes.
So those are the
So
two.
the first part of that question is you have a couple that has a plan and only one person needs care. Well, if it's a traditional plan and it's a couple applying, I always customize that plan with share care. It costs a little bit more, but it means that one person can actually inherit or tap into the other person's benefit. Now, I haven't had anyone say they didn't want that benefit like when it was available, but that's one way to address that. For the other person who, if you have a plan and you don't ever use care, you pass away before needing it, there are a couple things. One, if that's a big concern, then that's a good argument for a hybrid plan because that will have a life insurance benefit that's going to pay out to your estate, and that means it will not have been a waste of money. There's a return of premium feature to traditional plans where it's not even if you don't need care, even if you do need care and you pass away, all the premiums will be refunded. But honestly, I'm in a master class right now with other long-term care experts across the country. We were just talking about this. And just because we were all together, I actually asked, I'm like, I always ask this when I'm with a bunch of long-term care experts. I'm like, have you ever had a client purchase the return of premium option? And nobody has ever purchased it in my group. I've never met another broker who said they had a client that purchased that benefit. Now, I'm sure somebody has, but I have yet to meet someone who sold a policy where that was sold. Why? Because it makes the policy so much more expensive. You could be using those dollars with your wealth manager. You could be using it in so many other ways rather than just making sure that you get this money back.
One of the questions that came in was, how many years do you actually pay premiums into long-term care?
That's designed with your long-term care expert. Sometimes people will pay. Well, let me preface that by saying I always want to add a premium waiver if it's not already built into the policy so that when you're on claim, you're not paying premium. I just think that's onerous. But that said, there are plans where you pay to age 100. So if you're not on claim, if you don't go on claim and you live to age 100, you will be paying premiums until age 100. There are plans that have what are called 10 pay or 20 pay, where you can pay the plan off in 10 or 20 years. There are plans that say you pay until age 65. And there also are plans where you pay with a lump sum, meaning you take one lump sum of money, like with those life insurance
All
policies,
up front.
and you're done.
Yep.
So there are many
So
options.
answer the question is it's completely customizable. That's what it sounds like.
Yes.
Okay. Second to last question or so here. What are the advantages of getting long-term care if you're in your late 20s, early 30s? Now, I just want to speak to this question because my understanding as someone who's not an expert, right, is I don't even think that's an option, but maybe I'm incorrect in saying it.
Scott, you're learning like I'm learning. So many times I want to answer questions off just from my experience,
Yeah,
but then a little voice says, go check it out because this market is so dynamic and things are changing. So actually, a young person actually can get long
really.
term. I would have thought no.
Yeah, that's new information to me. I had no idea. Yeah, interesting.
I mean, why would they? Sometimes people are just scarred.
So what would be the
But
advantages then of getting it like in your 20s and 30s then as opposed to 50s or 60s?
so if someone, I actually spoke with somebody a couple months ago who was 35 and looking at purchasing long-term care insurance. And we were looking at a hybrid plan. And the benefit would be that that premium would be fixed. So at age 35, where she can qualify much easier because she's younger and healthier, that premium would be fixed. And she was also saying, oh, great. Well, I want to pay that off in 10 years. That would be a benefit. Do I always recommend that? Lots of times I'll just say, look, just because you can, does that mean you should? Of course, I'm in the business of selling long term care insurance. And sometimes people are scarred and they're like, oh God, I saw what happened with my grandfather and all this other stuff. But if they have other things that they need to be that are front burner issues, if they have young kids, well, they're probably thinking of college, they're thinking of retirement, they're thinking about maybe paying down a mortgage. I mean, these are all other considerations. But sometimes you have parents or grandparents that will purchase plans for kids, young kids. So, and you have it the opposite. You have kids also paying for parents' policies too. So there are lots of creative ways to look at it.
Yeah. So the question around what if we buy it and we don't use it? What if we don't get it and we need it? What if one person needs it? So I think that really feeds into like the idea of what we do with scenarios in financial planning, where you just simply run the plan. If we don't get either one of us don't get long-term care and one of us needs it, how does that affect our plan? Right? If we both
Yes.
don't get it and somebody needs it, what if we get it and both don't need it? How does that affect our plan? And the numbers get really clear as to what makes the most sense. So we would just encourage folks as we're wrapping up tonight, reach out to the wealth advisor in question that you work with. We're happy to introduce you to Carly with an email intro. She's wildly generous with her time to a fault. She loves this stuff, which I mean, I think she needs therapy for that. And so we really appreciate you guys taking the time. Carly, thanks so much for your expertise, your friendship. I know Carly for probably north of a decade, and we'll continue this series as the year rolls out. We've got the dual citizenship one coming up in about a week or so. Thanks again, Carly. If we didn't get to your question, or if you think of a question in an hour from now over the weekend, please get to your wealth advisor about it. We'll get Carly involved, and we will go from there.
Thank
So,
you, Scott.
yeah,
I really
pleasure.
appreciate your generosity and thank
Yeah,
you to W.
yeah. Thanks so much, guys. Till next time. Take care.
Good night.
Thanks. Bye.
The presenters of this information are expressing their personal views. This content is not endorsed by Werber Rubin, Papier Wealth Management, LLC, a SEC-registered investment advisor.